Dear friends and investors, welcome to our monthly video on markets and investing. Well, this month we will largely talk about the most important event of the month, and that was the union budget and what it means, what we think are the highlights, and how do we read the budget between the lines. To begin with, I think this budget did a superbly fine balancing act. Well, all budgets are a fine balancing act, but particularly this budget, I think, achieved superb fiscal consolidation along with giving, I would say, a reasonably good tax break to investors and still keep the focus on capex going. Let's first talk about the fiscal deficit. Now, you would think that why should a figure of fiscal deficit matter to us so much? Okay, it's great to have fiscal consolidation. I think beyond just being a figure, the fiscal deficit number is important on two counts. One, it tells us about the philosophy of this government. And secondly, what does it mean for economic policy? As we have always said, that this government is quite hawkish about fiscal discipline and policy. When I say hawkish, what it means is they do not believe in relenting on their fiscal deficit targets. As you all know, budget is always a trade-off. Do you want better fiscal discipline or you want higher growth? Obviously, we all desire higher growth, and probably the markets would have been happy had we budgeted for even a slightly higher fiscal deficit of, let's say, 4.5 or 4.6. But the government stuck to 4.4, showing a fairly handsome fiscal consolidation. And this is important because A, it paves the way for the RBI to loosen monetary policy and cut rates, because higher fiscal deficit means that the government has to borrow more, and if the government has to borrow more, it crowds out private investment and it makes RBI's job difficult to cut interest rates, and especially at a time when the dollar is so strong and the rupee is weakening. And therefore, it was extremely important for the government to show a very tight fiscal discipline, and that's exactly what the government has done. The other reason is that India has been aspiring to improve our global credit ratings, and usually the global credit rating agencies look at the country's fiscal discipline and reduction in deficits as a very important step if they were to increase India's ratings. And once India's ratings improve, the overall cost of capital in the country could come down. And that's why the fiscal deficit number is so important. And I think the government, by continuing to be on the path and being conservative, is actually a very big plus macro point for India. Now, coming to capex, given the fact that the budget gave a very handsome 1 trillion tax cut, there has been an overwhelming perception with investors and market strategists that the government has opted for consumption at the cost of capex. However, we believe that that is not the case. And the increase from 10.2 trillion to 11.2 trillion would ordinarily mean that the capex budget has gone up by merely 10%. However, it is important to note that in 24-25, the government was able to spend or is budgeted to now spend only 10.2 trillion as opposed to 11.1 trillion. And that, as we've reiterated in the past, that the government has not been able to spend in the first 9 months of the year, primarily due to elections, and hence we believe that on a lower base of 10.2 trillion, even if we were to take that, what it means is that your average monthly spend on capex has to be 85,000 crores, which is very simple. 10.2 trillion divided by 12, that comes to roughly 85,000 crores a month. Now, we have numbers from April to December. What the government has been able to spend in the first 9 months is 6.85 trillion, which comes to a run rate of 57,000 crores per month. So what it means is that the government, as per the revised estimates, is supposed to spend at the rate of 85,000 crores a month for the full 12 months, but they've only spent 57,000 crores for the first 9 months, which means that for the last balance 3 months, the government will have to spend a total of 3.3 trillion or a monthly run rate of 1.1 lakh crores till March of this year. And then if you take the budgeted numbers for next year, which is 11.2 trillion, which means a monthly run rate of almost 93,000 crores. And therefore, if you add up the balance 3 months of the current financial year, which is Jan, Feb, March, and the full 12 months of the next financial year, the government will actually end up spending 14.5 trillion rupees at a run rate of almost 97,000 crores a month. Therefore, when you compare the run rate of 57,000 crores in the first 9 months of the current year with 97,000 crores for the next 15 months, it tells you that actually the run rate spending over the next few months is likely to be 29 to 30% higher than what has actually been spent. And therefore, we believe that the capex story is still reasonably very strong, and there is no reason to believe that the government has done a big trade-off by saying that, okay, because we are giving you a consumption stimulus, we are going to cut back on capex. We believe that in real terms, in real cash spending terms, actually the next 15 months from Jan 25 up until March 26, if the government was to stick to its budgeted numbers, then we believe that the capex spending momentum should be reasonably strong. As you can also see from this bar chart, which is essentially from FY19 right up to FY26, you will see that consistently our monthly run rate of spending has moved up from 26,000 crores a month to now the latest at 93,000 crores a month. And if I take the 15-month period, then it is almost 97,000 crores a month. So in our view, the capex story is not dead, is very much alive. Then coming to the Make in India, we believe that one of the big policy tools that the government used to incentivize manufacturing was the PLI schemes. And if you look at the budgeted numbers for this year, we see a very handsome 50% increase in the amount set aside for PLI across various sectors, right from almost 16,200 crores to 24,500 crores, which is a 50% increase from revised estimate to the budgeted estimates for next year. And of this, the two largest areas where we've seen a very strong incremental growth in the PLI, one is in electronics manufacturing and hardware, and the second is in semiconductor and display. As you know, we've always mentioned that this is an area within manufacturing where we expect a significant momentum over the next couple of years, and the policy environment continues to be consistent with that as well. Well, now let's come to the biggest highlight of the budget, and that is the tax cut. The government decided that it was probably time to do something about the structural slowdown in consumption that the economy is seeing. And therefore, it bet on the middle class to drive consumption as the second engine of growth in the economy. And therefore, in this budget, the government decided to increase the tax-free limit from where income tax is applicable and increased it from 7 lakhs to 12 lakhs, thereby releasing almost 1 trillion rupees or almost 1 lakh crores of purchasing power in the hands of the middle class. However, if you analyze the slab-wise tax benefits, what we see is that the biggest benefit will occur to people who have income starting from 12 lakh going up to the bracket of 50 lakhs. That is where we believe that in percentage terms, the tax benefit is the highest. Now, as you know, that these are slightly well off or better off consumers, right? And if you look at this pie chart, what we've tried to show is that the government has really targeted a slightly narrow pie of the taxpayers. So as you can see that 20% of the taxpayers fall within the 12 lakhs to 50 lakh income bracket, and they will actually get 70%, which means of the 1 lakh crore, almost 70,000 crores of tax benefit will flow to this 20% of taxpayers, which is roughly 7 million households. Therefore, we believe that while this is a very encouraging stimulus, this is largely targeted at a certain demographic of income earners, which therefore we believe that while it should broad-base consumption recovery, a large part of it will be discretionary in nature and not the small ticket bottom of the pyramid consumption. And therefore, we believe that this should benefit a slightly more discretionary consumption. So things like tourism and travel, hotels, aviation, QSR, and so on and so forth should benefit more rather than lower end staples and FMCG, which still continues to struggle to deliver volume growth. However, I think that the government in its own wisdom has probably done a very smart thing. As you remember, in 2019, when the economy was slowing down, the government delivered a corporate tax cut. And now, when again we are seeing a cyclical slowdown in the economy, the government has delivered an income tax cut. As you all know, that in economics and generally for the economy, a tax cut is a big stimulus. And therefore, we believe that this bet that the government has taken to get the flagging consumption up and going should help in driving consumption, and once capacity utilization improves, it should also therefore indirectly help private capex. So in summary, We believe that the budget has been very balanced and responsible. The objective was to get both the engines of the economy firing, capex as well as consumption, as opposed to only capex. We believe that fiscal consolidation should help the RBI to ease monetary policy and cut interest rates. That in turn will also help to drive consumption. So yes, well, the budget has done all the right things, and that should help to lift sentiment both for the consumers and for the markets. Having said that, we do believe that on the external front, we still have some risks and uncertainties. We do not know finally how President Trump's trade policies will impact several economies, including India. While we have seen that the US has deferred putting any tariffs on Canada and Mexico by 1 month and is willing to negotiate with these two countries, it has gone ahead and put a 10% tax on Chinese goods, and China has retaliated. We will have to wait and see how this entire scenario unfolds over the next few months. And while it will be very imperative for us to navigate this short-term volatility, which I think should continue well into the end of this financial year, but I do believe that the process of bottoming out of the Indian markets have already started. I believe that relative calm should prevail by the mid to end March, and I do expect the markets, the economy and the earnings to pick up from Q1 of next year or from April. Till then, I think we should, as I mentioned last time, use this volatility to add to our equity investments, because I believe that the next 2 to 3 years should be pretty strong, and the current volatility and uncertainty actually offers long-term investors a great time to add to their investments. Thank you. Until next month.